So you've got your trading portfolio. You might have some core positions, you might have some income positions, some hedges, some earnings, some gambling, long stock, short stock, what have you. Got a mixed bag of things in your portfolio, but how do you know how much money you're going to make or lose each day depending on how much the market goes up? Well, that's a concept that I wanted to touch on today, called your beta weighted delta, and touch on that a little bit and how it can help your trading. Hello everyone, this is Ben with IncomeOptionsTrading, and today I'm going to touch on some portfolio metrics such as the beta weighted portfolio delta. Before we get started, just wanted to do a quick disclaimer that I'm not a financial advisor. This is not financial advice, and you should know what you're doing before you put any positions on, especially with options and futures, as they have a lot of risk. So today I'm going to be using the Tastyworks platform. I've used several different platforms in the past, and I've found that Tastyworks is the most helpful when it comes to managing your portfolio as a whole. So up at the top here, I have my account information, my portfolio information. It's got your basic P&L for the day, P&L for year to date, your option buying power and your stock buying power, and your P&L of all your open positions. And then some things that this platform has that some others might not have are your portfolio delta, your portfolio theta, your extrinsic value, and then your day trade counter and your BP usage percentage. So I'm going to be touching mostly on this delta number here and touch on how this number can help you with your trading and make sure that you have the bias that you want in your portfolio and get a grasp on how much can you make or lose each day depending on how much the market goes up or down. So this video is going to assume that you are familiar with the concept of delta. If you're not, delta is one of the main Greeks, the main metric for options. So I'll just use SPY here as an example. I do have some open positions here. I have a 451, 461 long call spread here in November. It's part of my modified ratio Super Bowl strategy that I previously did a video on, if you're interested in that. But I'm just going to go into SPY here, go into the November expiration. One of my columns is delta, and the delta on here is listed on a per share basis. So if we look at the puts here, the 0.50 delta is also known as 50 delta. So it's 0.5 per share, and each options contract is 100 shares. So 0.50 times 100 is 50, or negative 50. And basically what that tells you is, in this case with a put, if SPY drops $1, you will make 50 cents per share, or $50 per option contract. And same thing on the call, and the opposite way. So if you're doing the 449 strike here, which is the 50 delta call and put, if the market goes, or SPY goes up by $1, this call option will increase by 50 cents, which will be $50 because of the 100 multiplier. If the market goes against you, you will lose 50 cents. And another thing with delta that you should know is if you buy an option and the market goes in your favor, your delta will increase. So if SPY, which is at about 448 right now, if it goes up to 450, this 448 will now be further in the money, and it might go up to say 0.54, which is where the 446 is. So if you buy a call, you will get more bullish the more SPY goes up. And that's a concept that's important to remember when you're using options, as the delta is dynamic, meaning that as the option or as SPY or the underlying moves, the option delta also changes. And how fast that change occurs in delta is a second order Greek called gamma. And you might hear of gamma risk that happens with closer dated expirations. So like a 0 DT or even a 7 DTE, it's going to have higher gamma risk, meaning that the delta is going to move more viciously compared to a 65 days out expiration. So that's what each individual option delta is, just a quick refresher. So if we go back to the position tab here, we can see that the 451 long call, this ETF triangle, this triangle is the delta symbol. So the 451 call here has a delta of 46.6. And if we go back in here, we can see that it's 0.47. So this delta here is multiplied by 100, so that's your true delta. So meaning for every dollar SPY goes up, this 451 call will increase by $46 or 46 cents in the option value. And then I also have this 461 short call, and this one, because I sold the call, it's a negative delta, which is negative 29. And it's a lower value than the 451 because it's further out of the money. So the further out of the money you go, the delta is less, meaning a $1 move affects this further out option less than this closer in the money option. So also we can look at SPY underlying as a whole, and we can see our net delta in SPY, which is only this call spread, is the equivalent of 18 delta, meaning that if SPY goes up $1, I will make $18 on this overall position, which is just one call spread, like I mentioned. So if I want to know how much I would make on this position, if the market goes up and the market being SPY, it's pretty intuitive. It's just this delta. Now, what if you wanted to try to figure out how the market movement affects other stocks? Say, if we do like AT&T, for example. Because if SPY goes up $1, that doesn't mean that AT&T is going to go up $1. So there is a correlation between AT&T and the general market, the SPY, and that is how it calculates the beta weighted delta. So the beta weighted delta takes the position delta and it converts it into a equivalent SPY delta. So if you look at here, I have the MNQ, which is the micro E-mini NASDAQ, and I have a short strangle on 44 days out, and my overall position delta is just about 8. So that's with the NASDAQ, and my beta weighted delta is to the S&P 500, which is SPY. And so this column right next to it, the B triangle, is beta delta. And in this case, our beta weighting is to the SPY. So the 7.6 delta in the NASDAQ is equivalent to 6.43 delta in the SPY. So this is just a calculation based on the correlation. So if the SPY goes up $1, based on how the NASDAQ also correlates with that, that's how we get our beta weighted delta. So the platform calculates your beta weighted delta for each underlying and each position. And to get your portfolio beta weighted delta, it's simply summing all of these beta weighted deltas of your entire portfolio. So in this case, my portfolio beta weighted delta is -4, meaning that I'm slightly bearish, but it's basically delta neutral. And I have some general metrics that I consider bearish, neutral, and bullish. So my account value, or my net liquidation value here, which isn't shown, it's just over $8,000 right now. So this -4 is about 0.05% of my net lick. And I consider that delta neutral. So what I consider delta neutral is between -0.1% and 0.1% of my net lick. So with an account value of, say, $8,000, anything between -8 and +8, I would consider delta neutral. And I have a range just because this delta is going to move as the market moves and as your positions move. So you don't want to try to keep this at 0 if you're trying to maintain a delta neutral, because then you'd be constantly managing your positions, and that's just not doable. So right now I would consider myself delta neutral. Anything above 0.1% I would consider bullish, and anything below -0.1% of my net lick I would consider bearish. And basically, how far of extremes is up to you on your bias. So if you're really bullish, maybe you want to go up to 1%. So maybe you might have a positive 80 delta. That would be pretty bullish in my opinion. So as you trade, and if you use this number, so like I said, Tastyworks has this. Other platforms such as Robinhood I used previously, they don't have this this metric, and I find this very important with my trading. I do a lot of short option and premium selling strategies and hedges as well, so knowing this delta value is really important for me. So that's basically what the beta weighted delta is. One other thing I wanted to touch on, I touched on it briefly on my last video about how I like to keep negative deltas, and that I use that as a hedge against my short option positions. And I kind of wanted to explain that a little bit further here in this video. So to first explain it, I'm going to open up the Tasty charts here, and I'm going to do SPY on one side, and I'm going to do the VIX on the other side. So if you're not aware, the VIX is the volatility of the S&P 500 index, and it's based on the options that are closest to 30 days to expiration. So that's just kind of how that works. And I'm just going to use a little bit closer of a scale here. And it's kind of hard to see here, but generally speaking, as SPY goes up, the VIX goes down. So you can kind of see that here. As this part goes up, the volatility goes down. And as volatility goes up here, the S&P or the market goes down. And today we had a big green candle, and in the VIX we had a big red candle. So the volatility usually goes down as the market goes up. So that's an important relationship to know. So with short options, you are negative vega. So this V here is vega, which is the volatility of your option. And when you sell options, you are negative vega, meaning that you make money if volatility decreases. So today, volatility went down. I have, for example, this short strangle. I made money in that position today This resets at 5 o'clock, so it doesn't show it. But so as volatility goes down, that's good for your short options. And when volatility goes down, the market's going up. So if you have a positive delta and negative vega, that means when the market goes up, you win on delta and you win on the volatility contraction. So you win twice. But when the market goes down, you lose on delta and you lose on volatility or vega because volatility is increasing. So you lose twice as bad. So to hedge some of that, what I typically do is I maintain some negative delta here. And what that does is when the market goes up, I lose a little bit on my delta, but typically I make more money from my short vega position and also my long theta position. So theta is your time value. So when the market goes up, that would be good for if you have positive delta, but if you have negative delta, you lose. You win theta either way because time moves on. And if the market goes up, you win on volatility and you lose if the market goes down. So with the negative delta here, I'll make money as the market goes down, but I lose on my volatility. So in that case, my delta saves my portfolio a little bit. It hedges that. So I use that as my first line of defense for hedging. So just to explain one more time here in case I wasn't too clear, if the market goes up and you have a negative delta, I'll lose a little bit on the delta, but I'll make money from the theta and the vega. And I hope that the theta and vega components are larger wins than the delta. So net, I would win, but my negative delta here would be a drag on my portfolio. But when the market goes down, I will lose on vega, but I'll win on delta and theta. And I hope in that case that my delta wins more than my vega. And typically you don't really want that because that means that you might be a little bit too short in this bull market. And obviously the market could go bearish, but we've been in a bull market for 12 years, minus the COVID crash in 2018 and stuff like that. But generally speaking, we're in a bull market, so you don't want to be too short delta. Otherwise, you're going to have too much of drag on your portfolio. As far as how much short delta to have in your portfolio for a hedge, I like to stick around that negative 0.2% of your net lick. So for this $8,000 account, I would like to keep it around that negative 16 delta, and I would go anywhere from negative 0.1 to negative 0.3. I would consider in that negative 0.2 range. If you get beyond that, meaning negative 0.3 or negative 0.4, then you're getting to be a little bit too short and have too big of a drag on your portfolio over the years. The more short you are, the better off you'll be on downturns or bear markets or corrections, but frankly we haven't had a lot of those, so it's hard to play for that when it happens so infrequently. So that's beta weighted delta and how I use it. If you're just going to be doing a lot of short strangles and you want to keep this delta neutral, like I said, you want to keep it in that negative to positive 0.1% of your net lick. An easy way to calculate that is just how many thousands is your account value worth. So like I said, mine is about $8,000. So this is between negative 8 and positive 8. Delta would be considered delta neutral to me. And as you trade more, you might have different standards on what you consider delta neutral or bearish or bullish. But that's my range for that. And then I'm not going to touch on it too much, but there's also the theta component of your portfolio. I think this is also important to know, especially if you're selling options. basically the more theta you have, the more time component, means the more negative vega you have, meaning you have more risk. So essentially more theta means more risk. So you want to keep this in line with your netlick as well. For premium selling portfolios, typically I like to keep this between 0.1% and 0.5%. So right now I'm at about the 0.5%. So I would consider myself maxed out in this portfolio here based on my theta value. You can go up to 1%. I usually don't, but if you have some hedges on and you're more experienced, you can go up to 1%. But I don't recommend that. So I think that's all I wanted to touch on today. Hopefully you learned something. If you don't have a Tastyworks account, I will have my referral link in the description below. Now through the end of September, I know we're coming up on the end of September here, they do have a crypto promotion. So if you open and fund an account with so much money, you get some free crypto. So that's a pretty cool promotion there. Usually they have a promotion going all the time, and I am not sure what the one coming up here at the end of September will be. But if I find out, I will share that with you guys. If you have any questions or comments or any clarification needed for beta weighted delta or anything else in particular, anything trading related, please leave them in the comments. If you like this video, please hit like and subscribe. And thanks for watching, guys.